Thank you for joining our webinar, another one of our webinars in a series that we're going to be doing here. Be sure to visit YieldStreet.com to learn more about our offerings and sign up to receive the latest updates on our webinars and market updates. We're going to be talking about wealth management in general, and it's a vast subject, as you know, Jim, and I'm going to introduce Jim here in a moment. But with wealth management, there's a number of things to consider. We're going to focus a little bit more on the tax efficiency side of things, and go into the different aspects of how to engage your retirement plan funds and how to consider your investments with the tax efficiency in mind. So I'm the director of retirement services here at YieldStreet, and I joined the company last year when my retirement administration company was acquired by YieldStreet. We've now produced a seamless way for our investors to use their IRA to make alternative investments. And I'm not an investment professional, but rather I'm more in the background and creating the tools for people to use their retirement account to make investments. Jim, on the other hand, Jim is a 1989 Whitworth University graduate and has been a trustee for Whitworth for the past 16 years. He is owner and CEO of Level Wealth Advisors, a private wealth advisory firm of Ameriprise Financial in Bellevue, Washington. Jim has been in the investment community for more than 30 years. Jim holds the following designations: the CFP, the CRPC, the BFA, APMA, and he has been featured in many major news publications over the years and has been awarded the Forbes Best in State Wealth Advisor since its inception in 2017. And the 5-star wealth manager also since its inception. Ameriprise Private Wealth Advisors is a wealth management firm nationwide, worldwide, has extensive experience in helping affluent clients preserve and grow their wealth. They possess the capabilities and resources to provide customized recommendations and support for tax, estate, retirement planning. They help clients step back and explore the full range of opportunities their wealth can bring. With many years of experience and established network of expert resources, Jim and the select group of private wealth advisors at Ameriprise are among the most qualified and credentialed advisors in the industry. Ameriprise Financial gives this elite group the highest priority and quality service and resources available to help ensure their clients receive the best possible client experience. And that is why we brought Jim on board to help us go through this subject. So Jim, let's just start into why are some of the principles that we should consider with investors really, they haven't changed over a number of years. What are some of the beginning points that we should consider when looking at overall wealth management?
Well, first of all, Joe, thanks for having me. I appreciate being here today. I think, most people spend more time planning their own 2-week vacation than they do their own financial well-being. So for me, Joe, wealth management is really looking at all areas of someone's financial life. We look at it very similarly to the College of Financial Planning, and looking at net worth, cash flow, protection planning, which includes life insurance, disability, long-term care, healthcare insurance, property casualty. Then looking at your investments, looking at your accumulation goals, looking at when you can retire, how much can you retire on, what are the impacts of retiring later or earlier, how to optimize Social Security, and then the transfer of your estate either to your spouse or family or to your legacy. So it's not just, when I get on a plane and someone says, hey, what do you do? And I tell them I'm a financial planner, they immediately go, oh, should I buy, Microsoft or Amazon, right? I mean, that's the first question I get. And I go, no. I help people plan, their financial life, not just their investments. So, it's looking at the big picture, number one. And I think then when saving, to specifically answer your question, I think not much has changed from a savings standpoint other than I think it's important to have a plan. I think it's important to have a goal, as opposed to just jumping out and just saying, I'm going to start to save. You know, you don't jump in your car today without kind of plugging into your GPS on figuring out how you can best optimize to get from point A to B. So having a plan and then having someone like myself or someone like you all to help if you get off track to, as your GPS would, to reroute is an important aspect of financial planning.
So with tax efficiency, how important of an issue is that? Because we don't really want the tail to wag the dog on what you do with your investments and how you plan your finances, all just around that one aspect of taxation. But in your viewpoint, how should people treat that?
Yeah, great question, because a lot of times people will silo their investments and their taxes into two different buckets. I feel it's so important that I've actually added a tax firm into my practice. So we do financial planning and taxes, not just one or the other, because if you're, typically if you're working with, your broker or your advisor, or even independently, again, you silo yourself into those investments. You might think about taxes in terms of, and we can talk about that, how I specifically think about taxes myself when it comes to investing. But really, you think, a lot of people think independently, investments on one side and taxes on another. And really, that should all be think about and linked, in terms of what are your other income sources, where do you stand, from your adjusted gross income and your deductions, and how does that all feed into together?
Right. So tell me if I'm wrong on this theory. It seems like if you could present the perfect portfolio and the perfect situation with how everybody has their investments placed, is there a optimal way to have it all structured for tax efficiency when we're talking about your investments? Is it a formula?
Yeah, it is. And I don't know if, Sean, you can hear me on the line. Can you pull up that one graph that I had on our tax control triangle? Now might be a great time to bring that up. And
sure. Give me 1 second.
Great. So, Joe, what we use is what's called a tax control triangle. And, really one of the reasons why we do that is, and not just one reason, but three reasons. We use this for control, flexibility, and then increase the longevity of one's assets. So when we look at that perfect portfolio, if you want to call it that, we look at it in terms of three buckets. The first bucket being the tax-deferred bucket. That's the area where most people have the majority of their assets. When you look at, if I look at my book of business in my practice, I would say that 70%, if not more, of my clients' assets sit in this bucket. The other 30 is in the other two buckets. So as much as I'd like to have the perfect portfolio, it's not just my perfect portfolio, it's what my clients bring me. So, and when we look around the nation, we generally see that about 80% of clients' buckets of money are in that tax deferred section. So that's money that goes in right before tax, or it can go in after tax, but the money grows tax deferred. So those are things like 401ks, IRAs, annuities, those sorts of investments. Those are dollars that generally come out on a taxable basis. Usually if you take them out before the age of 59 and a half, there's an early withdrawal penalty. And because of the recent new Secure Act that was put into place, you can now have to start taking those out unless they're in a Roth format, which is the tax-free bucket. You have to start taking those dollars out at age 72. So that's where most people have the majority of the dollars. The second is in the taxable side of things. Those are the non-qualified accounts where people who will own individual stocks, bonds, mutual funds, REITs, real estate investment trusts. Maybe they're restricted stock units or stock options from their employer. And those monies go in on an after-tax basis and generally have a favor in terms of they come out taxable, but normally in the form of short-term or long-term capital gains. So if you hold them a year and a day, you get a more favorable tax rate for those. And then the third bucket is the tax-free bucket. Those are dollars that go into things like Roth IRAs, a Roth 401k, 529 plans for kids' education, municipal bonds or municipal bond funds. And then most people don't think about it, but if you're single, it's $250,000, and if you're married, it's $500,000 of earnings in your house comes out tax-free. If I had my optimal, I'd love to see a third in each bucket. My favorite bucket is the tax-free. Why not? But again, as I mentioned, the reason why it's important to have money in all three of those buckets, one is for control. If I have all my money in the tax-deferred, which is where I said 80% of most people around the country have their dollars, I have very little control. All of that's going to come out on a taxable basis, and I can't control my income tax bracket. But if I have money in the other two buckets, I have control to take it out and play the game in terms of which tax rate I'm going to be in, depending on the money I withdraw. It can be much more favorable. And as a result, if we time it correctly in retirement, when we're taking a retirement paycheck, you can extend those assets much longer.
So if people have cash in retirement plans that they're looking to invest, should they be looking at buying appreciating assets, income producing assets? Is there a different type of asset class that you would recommend in a retirement plan?
Yeah, so if we're talking about let's go back to the buckets just to make sure in terms that we've got up here. So if I've got money, in the retirement bucket, typically I'm going to have that in the tax deferred section, typically. In those assets, I do want to have as much as I can in the growth side, especially if I'm younger. All right, I want those dollars to grow and defer the taxes to a later date. Same is also true in the tax-free aspect. If I can put money into a Roth IRA or a Roth 401k, and I can have my assets grow tax-free even better, because, again, I keep going back to it, Joe, as I said, most people have 80% of their money sitting in that tax-deferred bucket. If I can put more money in that tax-free category, and I can put, a lot of growth assets in that category, as I mentioned in terms of Roth 401ks or Roth IRAs, great way to be putting money in and taking money out. I like to reserve the taxable bucket. If I'm going to do that, I really am a big fan of tax-free municipal bonds, because I like the tax-free growth, and many times also in the tax-free quadrant, if I don't have money in the retirement account, and I max that out, which I try to do first, I like the high yield, munis, because I can get, 5, 6, 7% tax-free. You add on your tax rate, and I can be getting a tax equivalent yield of 8, 9, 10%. Those are more like equity returns, on a tax-free basis. So,
right. Could you talk a little bit about capital appreciation? So the short-term capital gains versus long-term capital gains versus assets that are going to be producing taxable income with
sure. With what? Sorry, I missed you there. Clicked out.
Yeah, with the interest. So you have maybe some bonds or some assets that are producing ordinary income type spinoff. How do you treat those different types of buckets?
Yeah. So again, in terms of that, if I own an investment for 1 year and a day, right, it's considered long-term capital gains. If I own it less than a year's time and I sell it with those gains, I'm going to be in the short-term income tax bracket. I'm going to pay that at ordinary tax rate. So right now, our long-term capital gains is 0, 10%, 15%, and 20%. And for those, that have income over $200,000 or 250 as a married couple, there's the net investment income tax that adds another 3.8%. So I try to avoid, right, if I can, be in that tax-free quadrant as much as I can. And as an investor, I know there's a greater chance of making money the longer I hold on to something. So if I can hold on to it for a longer period, make more money, and do it in more tax-efficient manner, being 1 year or longer, I'm going to be better off financially and extend those assets.
Okay, so YieldStreet is involved in the alternative asset space. So we do alternative financing. So we lend on asset-based programs. So if it is a income-producing alternative investment, is there a particular bucket that it fits better into?
I mean, really, they would fit into all three buckets, almost depending upon, what you held or how you owned it. So the alternative can be held pretty much in all three buckets. It's just how it is ultimately taxed, depending on which bucket you have it in. So in many times you can own an alternative in the tax-deferred. Most likely you'll find it in your IRA account, or sometimes, I don't see it often, but sometimes I do see alternatives in 401ks, not often. Those are normally limited by choices. Again, in the after-tax side of things, you can see alternatives in the taxable space. Again, it's important on those alternatives that, again, like we were talking about, owning it for more than a year. I think in the alternative space is especially important because alternatives typically can be more aggressive, than say a CD, money market, even a corporate bond. So you want to hold that longer, and you could own it in the tax-free section in a Roth IRA.
So with the CARES Act that came out, the CARES Act has said that you could take a distribution from your 401k or IRA, and instead of the 60-day rollover period, you could roll it back into another qualified plan within 3 years. So that's new. So you can take a full distribution of a retirement plan 3 years from now, roll it back into another plan, and it's a full rollover. Do you see a reason for anybody to do that, and where does that come into play?
Yeah, a couple things on that for what I read on that. One is you can take $100,000 out of a qualified plan, and up to $100,000, and then pay that back over a 3-year period. So if I take out $30,000, I've got to pay that back over, $10,000 a year back into that to defer those taxes. So now there are some qualifications for that, Joe, as I read that. In terms of you've had to have had COVID yourself, been diagnosed with it, or a family member was diagnosed it, or you were impacted by COVID-19 in terms of it impacted you, or you were furloughed, you were laid off, you were impacted with your child's care because you had to take care of your kids. So it's some of it is pretty ambiguous. I can't say the word today. It feels like a Friday or a Wednesday. But the IRS has those rules. But I think it's smart. If someone had the ability to pull $100,000 out on without having to pay tax, and tap into that and pay that back over a 3-year period. It would not be the first place that I would pull out dollars, but it would definitely be a place, if I were impacted, that I would want to look at and take advantage of that opportunity as part of the CARES Act.
We have some investors at YieldStreet who are having some type of liquidity event where they're selling a business or have a major asset sale, and they're in the top bracket. They're phased out of their deductions, and they're just being hit with a lot of taxes. What would you recommend for somebody in that situation?
Well, there again, that's where I really like the tax-free bucket, right? Where we had dollars that were sitting into, whether it's in pulling money out of a Roth, or again, I very much like the a high yield tax-free municipal type of investment is a great way to go. Because again, I can get equity-like returns with bond-like risk. I know that they had somewhat of a hiccup, like everything else did back in February and March of this year, but the Fed did come back and backstop quite a bit of that risk, by purchasing shorter-term municipal bond holdings. But it did shore up quite a bit of the fear and risk that was in that part of the market. So that's an area that I like quite a bit, especially for clients that are in the higher tax brackets. Because again, you need to look at the tax equivalent yield on those dollars.
Right. Well, so we see a number of YieldStreet investors now rolling out of their 401k plans from old employers and purchasing some of our shorter mid-duration fixed income products. But what do you think with their IRA account? But in general, what do you think about people rolling out of 401ks versus just leaving it at their old employer's 401k plan?
Yeah, I'm a big fan of that. Obviously, there are benefits and pros and cons of leaving the money there as opposed to pulling those dollars and putting it into an IRA. Protection is one of those, right, from a legal standpoint. Those dollars in a 401k technically don't belong to you, and they are wrapped within ERISA rules. So there's some legal responsibility that the 401k plan administrator has with those dollars. But I like the more of the freedom, control, and the flexibility that an IRA offers to a participant. Just an ease of use to begin with. It's much easier to manage an IRA than it is a 401k. I also think that I like the distribution options that you get from an IRA as opposed to a 401k. And there are new rules I think you may know that have come out again as part of the Secure Act that came out in terms of you can now defer your IRA until the age of 62 as opposed to 70 and a half. That's good. That defers that for a couple more years. The downside, if I did, 72 versus 70 and a half.
Right.
So thank you for correcting me. But the other is now that the non-spouse beneficiary has to take those assets and has to withdraw those over within a 10-year period. It used to be over their lifetime, but now it's over a 10-year period, and that is and it's much more easily done in an IRA account than it is a 401k. And then I like the investment options. Usually you're limited by the number of investment options you can choose from within a 401k, and you have unlimited options for the most part within an IRA.
Right. So with tax efficient investing in general, what are the things that we not talked about that comes to mind that people should be considering when looking at rearranging their portfolio or putting cash they currently have to work?
There are a couple things I would say. I think first of all, looking, especially if we had, like when we had times in February, March, if we were to see another pullback in the market, looking at a Roth IRA to Roth conversion makes a lot of sense. You'd want to look at it on each and everybody's individual situation, but Roth conversions make a lot of sense for people. I also think that, making after-tax contributions to a 401k. So if you max out your 401k, which by the way, I think is, if you had to choose between an IRA and a 401k and where to contribute, 90%, if not 99% of the time, I would tell you, Joe, to contribute to your 401k, really for two reasons. One is I can put more into the 401k than I can my IRA. Number two is that I get free dollars. I get a matching contribution with those dollars. But once I max out what I'm contributing to a 401k, I'd want to put in after-tax dollars if my employer allowed what's called an in-service distribution. And that's something you can look up and ask for a summary plan description. And in it, it'll say who's allowed to take an in-service distribution, meaning while I'm still working, I can make a distribution from my 401k, and I can take those after-tax dollars and move those into a Roth IRA. And again, that Roth IRA is that third bucket that is tax-free growth.
So is it a taxable event when that happens?
That's a non-taxable event at that point in time. The only time it would be a taxable event is if I put in after-tax contributions into my 401k, and those grew. I just had like an unbelievable quarter or year of growth. So remember, we talked about capital gains. So if my $5,000 becomes $8,000, I might pay some income tax on that $3,000 difference of the growth. Still, that's a small amount to pay, and generally you'll do those in-service distributions about every 6 months. And so you generally in a 6-month period wouldn't see a 30 to 40% increase. I mean, you may, but you typically don't see those as much, quarter to quarter or 6 months. Take that money out, put it into the Roth, and then let that money grow tax free for the rest of your life, because those Roth IRAs are not subject to those required minimum distributions at 72.
Right. So somebody with traditional IRA funds, what factors should they be considering when they're looking at doing a Roth conversion or not? And what is the thought process around that?
So you'd want to look at your own taxable situation in terms of, does it make sense just moving from one to the other? The other is the timing aspect. You typically would want to do it when you might be in a lower tax situation, or where your account balance has fallen. So let's say a great time would have been looking at that February-March frame of this year, when we saw the S&P 500 drop by 35%. I could then convert that over to a Roth IRA and then have those dollars. We've now seen a 30% increase, if not more, from March to today, that would have happened on a tax-free basis.
Is it still an opportunity for people, or do you think we're past that point of low values?
A good market timing question, right? I wish I had the best crystal ball, but I'd say there's probably a 50% chance now that the market's going down, and I'd bet that it's going up at this point. But, I think there will be, as there is always, another chance in the future where you'll be able to do that again. The other that I think's good to do, Joe, is again, depending on your age, is do a mixture of not only pre-tax contributions to your 401k, but after-tax contributions to your 401k, depending on, especially if you're younger. If you're in a younger age, a Roth IRA makes a lot of sense if you're younger and can contribute to that. Again, there's a real simple formula: time plus money equals financial success. The more you have of one, the less you need of the other. So if I've got a lot of time but not a lot of money, a Roth IRA makes a lot of sense. And so I really like, for my clients that are in the parents and grandparents that are in the higher income tax bracket, they can do gifting. They can gift to their kids up to $15,000 per person, $30,000 for a couple, right, per child. And that child could then make a contribution to a Roth, potentially make a contribution to a Roth IRA. And then those kids could have that money, grow tax-free the rest of their life. And it's a great way for, someone who's in the higher tax bracket, who may have a large estate, that wants to start moving money out of their estate and to their kids in a very favorable manner.
So we're starting to get some questions in, and we can go into the question and answer phase. One question we've got is, people are wondering about cash value life insurance policies, and are they a good idea, and what type of person would utilize them?
Yeah, those policies many times land in that tax-free bucket because you put money in after tax, and you take money out on a very tax favorable basis because you typically can borrow against those policies. And so usually what you do is you borrow on the gain of those policies, and they charge and pay an interest pretty much at the same rate. So if, just going to make it up, so they charge you at 5%, but they pay you at 5%, so it's a net zero cost loan. So it's a very effective way to add dollars and again have them grow on a tax-free basis for you. I also like those policies when you can also add a very inexpensive long-term care rider to those. And it's a way that someone can set aside dollars for their retirement. So let's say, again, they've maxed out all of their retirement accounts. They've got extra dollars to spend above and beyond and save. They can start putting in large chunks of money that grow on a tax-deferred and, again, efficiently taken out tax-free basis for their retirement. Those work great for retirement. Those are great plans. And they can grow, at growth rates. You can put them in equity-type funds. But you can add a very inexpensive rider to it for long-term care, which is one of the single largest expenses next to medical expense, healthcare, that people potentially could have in their retirement. And so the nice thing I like about that is that if I don't need the care, I still have the dollars that I can go after for my retirement for an income stream. But if I need the care, then I can tap into it for nursing home or whatever expense that I would have for my additional care down the road.
Right. Okay, so on the other spectrum, we've got a question. This person has asked, I'm relatively young, late 20s, and this person doesn't like the idea of putting money in a tax-deferred account that they can't access until they're 60 plus. So what value do these accounts have for someone like that when making over $250,000 a year? Isn't building home equity and those types of things an important thing to do?
Yeah, I'm never a person that says you should do all of something or you should do nothing of something. So I think for me, it's a balance between it all. And that's where we started off with the initial conversation about financial planning, is looking at the whole picture as opposed to trying to isolate out, different parts of your life. So I'm a big believer in, having a cash reserve. I'm a big believer in saving efficiently for retirement. I think IRAs and 401ks and saving on a pre-tax or after-tax basis makes a lot of sense. In many cases, if I'm a young 28-year-old, I'm assuming single individual, you know what, I'm going to pretty much be in the highest tax bracket. I'm going to love that 401k to reduce my taxes today. And more than likely, I'm going to be, you never know this, but I'd be doing a mixture between the Roth 401k and the Roth on a after-tax basis and a Roth pre-tax contribution. And then I'd be saving money outside of that as well. So that I'm not, again, using that tax control triangle. If I had my perfect portfolio, as we talked about, I like a third, a third, a third into each bucket.
Okay, with that in mind, with the distribution that you would, or the amount you'd have in each of the buckets being a third, a third, a third, with the current economic landscape, this person has asked, does the weight of any of the triangles change short term or not? And in any case, would the weight of the triangles change to help mitigate or take away some risk in any way?
Yeah, it would definitely mitigate risk. And I flip it around another way in saying, I don't know from a short term, but I know from a long term that things change. We talked about being a financial GPS and rerouting. So when tax laws change and income tax laws change and, my income changes, by having money in all three buckets, it gives me the greatest control and the greatest flexibility to have money in each of those buckets. And again, when I go back to the national average and I look at my own practice and I look at practices among, at least Ameriprise, 80% of most people have their dollars in that one tax-deferred bucket. So my point is that, again, I'm not telling you not to be in that one bucket. I'm telling you to look at all three. so that you have the greatest control and flexibility when things do change down the road, and they will change.
Right. Okay, so here's a good question. How can you pitch to an employer to provide a 401k plan or a 401k Roth option if they don't have one right now to make employees happy? So the question is really more about the 401k Roth option bucket. How could they pitch that to their employer?
Yeah, so the 401k Roth option is really super easy. It's typically in most 401ks, it's an add-on option. It's very inexpensive or almost not even a cost to add that on to a 401k for an employer. And most 401ks that come out today are automatically come out with both options. It's just a no-brainer. It's an amendment. It's a very simple amendment to an existing plan. If someone doesn't have a 401k at all, then their only option is the IRA option, and then that's where they would look at the Roth IRA or traditional IRA.
Okay, so questions come in if they're maxing out their 401k contributions of how much they could possibly contribute to the plan. How much can they contribute to an IRA after that?
Well, they can contribute up to that, depending on their age, $6,000. And then $7,000 if they're over age 50 on an after-tax basis. They can contribute to the IRA. They just can't deduct the IRA contribution at that point in time because they're able to deduct so it all go in on an after-tax basis. Now, what many people do is they'll also contribute to their IRA on an after-tax basis and then convert it to a Roth. You've got to be a little careful with that because if you have pre-tax IRA contributions and then you convert after tax over to the Roth conversion IRA, when you go to take that money out, it's done on a pro rata basis. So I'm going to make up a number here just for an example. If 80% of my assets are in a traditional IRA and 20% of my assets I've converted to the Roth, when I take money out, even if I take it out of the Roth conversion, I'm taxed on 80% of it. It's as if I took it out of both. They look at it on a pro rata basis from both those plans. So now if you don't have, so for example, I have a dentist who is a client of mine, and we rolled his IRA dollars back into his 401k. And so he had come from another firm. We had rolled his IRA. We started a new 401k. We put the IRA dollars back into the 401k. So having the IRA separate is different than doing an after-tax contribution now in an IRA and moving it into a Roth conversion where I have no other traditional IRA assets. Does that make sense?
Yeah, right.
So you just have to be a little careful. And that's where, again, it's important when we were talking about why I've added not only financial planning and taxes, all of those pieces have to fit together, and you can't look at them in an isolated event.
Right. So questions come in about the backdoor Roth contribution that we sometimes hear about. What is that, and do you recommend it?
Yeah, that's what I was talking about with the adding extra dollars into your 401k on an after-tax basis and then pulling those out with an in-service distribution. I love that. You just have to pull the summary plan description to see if it's allowable for people. Some companies don't have that written into their adoption agreement. Some companies, you have to wait till a retirement age. Many companies today are getting smart with it and saying, no, we're going to allow in-service distributions at any point in time, no matter what the triggering event is.
Okay. The questions come in, as a financial planner, what are the main questions you ask new clients to start with?
Well, the first one is, or what are your goals? What do you want to achieve? That's where we start is, where are we going? Where are we going? And then my job is to help you get to that point. So the first is, where are you going? Let's put together that financial plan. Financial planning is all about setting goals, developing a plan, implementing the plan, and then monitoring it. So again, I'm going to go to, what are we trying to achieve here? Once I know what we're trying to achieve, then I'm going to ask the clients about their risk tolerance. That's really what drives a portfolio and how you allocate it correctly. I think it's one of the most important questions asked when it comes to investing is knowing what your risk is, because there's so much access to information these days that people are short-term investors. I don't care if you tell me all day long I'm a long-term investor. You're not. Nobody is, because every time I open up the TV, it's breaking news, breaking news, breaking news. It's instantaneous. And, we've had more money sitting on the sidelines in cash than ever in history, and people just missed one of the greatest run-ups that we've just had, right? We've had the most volatile days upwards and downwards in the last 90 days here. So I ask, where do you want to go? What do you want to do? What do you want to achieve? I'm going to ask about risk tolerance. Then we're going to talk about, what's your income needs? What are your expense needs? We're going to formulate a plan together in terms of, all that I talked about in terms of a comprehensive plan: net worth, cash flow, debt management, buying a house, protection planning, balancing your investments between fixed and equity assets, estate planning, taxes, all those things we're going to put into play.
Right. Okay, a question has come in. How do you transfer existing alternative fund investments held in a brokerage account into a Roth or 401k? I'll answer this a little bit because finally we get a question that's really my wheelhouse, which is the private asset custody type area. And you can transfer private assets and you can convert those assets from a traditional to a Roth account. One of the challenges to alternative investments is they don't have a daily price like a stock or a bond. So in that situation, you just would have to have that asset valued. We'll reach out to you later and tell you how that's done. The question is, what is your view of self-directed IRAs and are there downsides to it? Do you want to touch on self-directed IRAs at all here?
Yeah, I think self-directed IRAs are great. I mean, as I've been doing this for 30 years, I kind of think there's three different types of investors out there. There's the do-it-yourself investor, right, who's going to use a self-directed IRA. On the other extreme, there's clients who want to completely transfer all of the risk and the experience and the knowledge to somebody else to do it for them. And then there's the third client that wants a hybrid. They want to do a little bit themselves, but they also want to use, the expertise of an advisor. So I think it's great. I just think it's important that, as I mentioned, that you really understand what your risk tolerance is and your time frame, and really are able to manage your behaviors. One of my designations is a behavioral financial advisor. That's the BFA designation. And what that talks about and what it shows and is proved through a Dalbar study that over the last 20 years, the stock market has averaged about 10% a year. The average investor has earned less than 5%. So it has nothing to do with the self-directed IRA. It just tells us that the average investor is not as an efficient investment money manager as the market is.
Right.
And that has to do with behaviors. Most clients, buy high and sell low, and they let their behaviors get themselves in the way. And so, again, nothing against self-directed IRAs. I think it's more about managing your behaviors and knowing your risk tolerance and putting together the right asset allocation. Interestingly enough, I was just looking at, you've probably seen it, Joe, the quilt chart that shows the different asset classes and how they perform year to year and over. I was looking at it from the 1990s through 2000s through the last decade here. And interestingly enough, I just looked at the last 2 decades. The asset class that was on the top in the first decade was the best performer. In this last decade, it was the worst performer. And the one that was the worst performer 10 years ago was now the number 2 and 3 performer in this decade. So, you got to be careful not just to chase performance. It usually zaps you.
Yeah, emotionally, that's difficult to do. but I know you've got a hard 5 o'clock. You're a busy man. I'm going to wrap this up. You summed it up very well. Just the last few things you said. You covered, the main closing arguments here. But what I want to say is visit YieldStreet.com to learn more about our offerings and come to realize your next level with YieldStreet. If you're an originator, be sure to click through to the Raise Capital page or reach out to originations team at originations@yieldstreet.com. And stay tuned as we release content on a regular basis. And stay safe and stay healthy. And Jim, I really appreciate you coming on and doing this with us.
My pleasure, Joe. Good luck, Godspeed to you all.
Thank you.